Welcome to Tesla Daily News podcast on Sunday, December 28th, 2025. Today, we're breaking down the Tesla headlines that actually matter for shareholders: regulation risk, Cybertruck momentum and limitations, robotaxi competition, and a major Tesla energy project that could move the needle. First up, the NHTSA is looking into Tesla door emergency releases, and this is the kind of safety story investors ignore at their own risk. The hook here is simple. A complaint alleges a driver was trapped during a vehicle fire because the mechanical door release was hidden, unlabeled, and difficult to use. The context is that Tesla's design philosophy leans heavily on minimalism and electronic controls, but regulators care about what happens when power is lost, smoke is present, and seconds matter. The details from coverage around the investigation point to emergency manual releases that are not intuitive in some Tesla models, with reports of at least one driver escaping through a rear window. The impact for investors is twofold. One, any NHTSA investigation can evolve into a recall or a mandated fix, which means cost, service load, and headlines. Two, and more important for valuation, it pressures the autonomy narrative. If regulators perceive basic human factors issues in emergencies, they can take a harder stance on expanded driver assist permissions. The takeaway: watch for whether this stays at the evaluation stage or escalates into an engineering analysis, and whether Tesla addresses it via software prompts, labeling changes, or physical hardware updates. Second story: Cybertruck scored a major safety win in the US, but it still has a Europe problem. Here's the hook. The 2025 model year Cybertruck reportedly earned the IIHS Top Safety Pick Plus award, which is the top tier. The context is that Cybertruck has been criticized for its sharp-edged stainless steel design and questions about crash compatibility. IIHS recognition helps Tesla defend the product and can support demand and residual values in the US. Details from reporting suggest Tesla made updates that improved results, with particular attention on areas like lighting performance and crash test outcomes under stricter standards. But the other side of the coin is distribution. Multiple outlets continue to note that Cybertruck remains effectively blocked from broad European sale due to regulatory and homologation hurdles. Impact: the IIHS award is bullish for US sales optics and brand safety credibility, but the inability to sell in Europe caps global volume potential and keeps Cybertruck as a regionally concentrated product for now. Takeaway: Cybertruck is improving on safety metrics, yet Tesla's next growth step for the truck hinges on regulatory pathway and product adaptation, not just consumer interest. Third story: Cybertruck demand and resale value could be heading toward a reality check. The hook: at least one prominent auto commentator is forecasting a steep drop in Cybertruck used pricing, potentially down toward roughly $35,000 within about 18 months. The context is that Tesla pricing can be volatile, and EV residual values depend heavily on supply growth, incentives, and new model pricing behavior. Details here are not official Tesla numbers, but the market signal matters. If used prices slide fast, it can spook potential buyers, pressure leasing economics, and feed a negative narrative around product market fit. Impact: lower resale values can increase cost of ownership perceptions and reduce demand at the margin. For Tesla, that can translate into more price cuts, which then compresses automotive gross margin, still the key metric Wall Street watches. Takeaway: if you're modeling Tesla automotive profitability, don't just track deliveries, track pricing power and residuals, because they influence both demand and margins. Fourth story: Tesla Energy quietly delivered one of the most investable headlines in this batch, a big grid battery project in Australia. The hook: Neoen and Tesla Energy are tied to the Goiter battery build in South Australia, described as 226 megawatts with 866 megawatt-hours of storage. The context is that Tesla's Megapack business is increasingly the company's margin stabilizer when EV pricing gets competitive. The details matter. 226 megawatts refers to the instantaneous power output, while 866 megawatt-hours tells you how long it can discharge, roughly close to 4 hours at full power. Impact: projects like this support Tesla Energy revenue visibility and reinforce the thesis that Tesla is not just an automaker. For valuation, investors are increasingly willing to pay for Tesla as an energy infrastructure and software platform if the segment keeps scaling. Takeaway: keep an eye on Tesla Energy backlog and deployment cadence. This is where Tesla can compound even if auto growth is choppy. Fifth story: robotaxi competition is accelerating globally, and the market is not waiting for Tesla. The hook: multiple reports highlight expanding robotaxi deployments and feature upgrades from competitors, especially Waymo. The context is straightforward. A meaningful slice of Tesla's current valuation is tied to autonomy optionality. If competitors normalize paid, driverless rides first, Tesla has to prove its approach can scale safely and economically. Details. Coverage suggests Waymo may integrate Google's Gemini AI assistant into robotaxis, aiming to improve passenger interaction and usability. Separately, broader reporting describes limited commercial rollouts across regions, especially in China and parts of the US. Impact. This raises the bar for Tesla. Even if Tesla's full self-driving improves, investors will ask, when does it translate into regulated, revenue-generating robotaxi service, and how does Tesla compete against fleets that already operate without safety drivers in defined areas? Takeaway. Watch for Tesla-specific catalysts, permits, geofence launches, insurance frameworks, not just software version releases. Sixth story. Tesla's mission statement change is small on paper, but it has real branding and investor relations implications. The hook. Elon Musk says Tesla is dropping the word sustainable from its mission statement, shifting language toward abundance and amazing abundance. The context is that Tesla has historically benefited from ESG-aligned capital flows and an identity anchored in decarbonization. Details from multiple outlets describe the wording change and the public debate it triggered. Impact. On fundamentals, a mission statement doesn't change revenue tomorrow. But it can influence analyst sentiment, ESG index narratives, and brand perception, especially in Europe, where environmental positioning matters for adoption and regulatory goodwill. Takeaway. Investors should separate optics from operations, but don't dismiss optics entirely. Tesla is a narrative-driven stock, and narratives affect multiples. Before we wrap, a quick market framing note. A few pieces in the feed reference Tesla trading near record levels earlier this month and emphasize how much of the rally is tied to autonomy and robotics expectations rather than just near-term auto earnings. Let's close with the big themes for today. Regulatory scrutiny is back in focus through the NHTSA door release investigation. Cybertruck got a safety credibility boost in the US, but faces real constraints abroad and uncertainty in resale value. Energy storage remains one of Tesla's clearest, most measurable growth engines, highlighted by the 226-megawatt, 866-megawatt-hour Goiter battery project. And the robotaxi race is heating up, competitors are shipping, and Tesla needs concrete commercialization milestones. For tomorrow, watch for any new NHTSA updates or Tesla responses on emergency egress design, and keep an eye on autonomy headlines, permits, pilot announcements, or partnerships matter more than hype. If you want this daily, subscribe to Tesla Daily News Podcast and follow us for the fastest investor-focused recap of what's moving Tesla's business and the Tesla narrative.